Hello and welcome. In this video, we're going to be talking about why now is a perfect time to consider investing in non-performing notes. So I'd like to tell you a little bit about myself and my company. In 2013, my company, United Capital, was formed by a group of professionals from both the real estate and mortgage industry. We formed this company because we saw the opportunity created in the current market for investing in notes and mortgages. And we are based in Denver. Okay, well, all of Denver doesn't look like this, I must confess. Most of these pictures were taken in the mountains outside of Denver, except for that shot in the lower right that was taken in the city. You know, I grew up in Denver, and I went to college in California, and people in California would honestly come up to me and say, "Did you ski to school?" Well, no, we didn't ski to school in Denver. Although I'm not going to say I never see people break out the cross-country skis after a good snowfall here. But I digress. I'm Beth Hale, and I've been investing in real estate for over 10 years. I'm the founder and managing member of our company, United Capital, LLC, and I'm extremely proud to say that the team we have put together has more than 72 years combined experience in the mortgage lending and real estate industry. So let's talk a little bit about investing today. According to the Wall Street Journal, the U.S. economy shrunk more in the first quarter of 2014 than it had in the 5 years previous to that, which includes most of the recent economic downturn. This article went on to say that the pullback represented the fastest rate of decline since the recession, and was the largest drop recorded since the end of World War II that wasn't part of a recession. In May of last year, a Nobel laureate in economics suggested that the stock market may have once again become overvalued. He was quoted as saying, "Stocks have been more expensive only 3 times in the last century, the 1920s, the late 1990s, and in the prelude to the 2007 financial crisis. Gee, what could possibly go wrong?" 2013 proved to be the worst year in history for bond funds, according to CNN Money, as more than $72 billion was pulled out of the bond fund market. Of course, investors started rushing back in early 2014, leading economists to predict a bubble. Anybody else get a little nervous when you hear the word bubble? You know, it's funny. In the world of finance, a bubble is bad, but a balloon, well, that's pretty good. Now, with all that has happened in the past few years since the recession, and with a lot of people losing huge amounts of money in their retirement account, you can't blame people for just parking their retirement money in money market funds until they can think of something else to do with it. Regarding this decision, one analyst at Vanguard said, "What seems like a prudent temporary decision can become an ill-advised longer-term investment choice." In other words, people are nervous and they don't really know what to do with their money. What about investing in real estate? Distressed real estate assets offer excellent investment potential because they can be purchased at a discount, which not only reduces risk, but it also increases profits. Basically, there are 3 ways to acquire distressed real estate assets. REO property, which is when the bank takes back a property that the homeowner previously owned, and we're including bank foreclosures purchased at the courthouse steps in this category as well. Short sales, where you can purchase the property at a discount directly from the bank before the bank takes back possession of the property from the homeowner. Although anyone who's actually invested in real estate through buying short sales from the bank probably would object to my use of the word direct when it comes to doing anything with the bank. Short sales have a reputation for being a lengthy and arduous process with long periods of waiting and uncertainty. And non-performing loans or notes, which is what we're going to be talking about today. This chart from the National Association of Realtors shows housing inventory for the past 10 years or so. Now, this includes REOs and short sales. Now, you would expect inventory to peak at the height of the recession, as it shows by the second bar in 2008 there. But look how much inventory has fallen between the last two bars in just a 2.5-year span. So where do we think all this inventory is going? Add to the drop in inventory, housing prices have been going up for some time. This slide from CoreLogic shows a 7.4% increase in home prices nationwide in the 12-month period ending in July of 2014. So inventory is down and prices are up. There are several reasons for this, and for now, I want to talk about one of them. Hedge funds. Hedge funds have jumped back into the market in a big way. Even back in 2013, the hedge funds were major players in the real estate market. This slide shows 6 of the biggest hedge funds buying up over 75,000 single-family homes in 2013. And in that same year, they raised another $8 billion to buy single-family home foreclosures and REOs. Now, I don't know if you guys remember, but back in 2012, there was a lot of controversy involving mortgage companies and claims of questionable lending practices. This led to a pullback in the mortgage companies pursuing foreclosure, and that led to fewer foreclosures and REOs being available on the market. Analysts predicted this would be temporary. They predicted that once those claims were resolved against the banks, there would be a huge wave of foreclosures hitting the market, driving home prices down. But that never happened. Why? Because banks started easing up short sale restrictions and selling non-performing loans instead of foreclosing on the houses. So when it comes to investing in distressed real estate, we know that housing inventory is drying up, prices are going up, hedge funds are buying up property all over the country, and banks are much more hesitant to foreclose on properties. So now let's talk a little bit about notes and why market conditions have created a very favorable market for the distressed note buyer right now. Now, before the real estate crash, this is what things looked like. You had your large bank, practically anybody could get a loan. You had a small department represented by that little red building in the lower right doing the loss mitigation for when people defaulted on their mortgage. And after the crash, well, we just sort of switched buildings. Now this slide is meant to be a little bit of comic relief, but like most jokes, it has its basis in truth. In May of 2014, it was reported that the rate of mortgage delinquency hit an all-time high. Now, when we talk about delinquent mortgage notes, we are talking about homeowners that are behind on their mortgage by 90 days or more. So this slide is talking about the percentage of people who are delinquent, that is to say, more than 90 days behind on their mortgage nationwide. The industry defines a stable market as one in which 6 out of every 100 mortgages are delinquent. Now that might seem like a high number for a stable housing market, but that's historically what they find. In August of 2013, the delinquency rate nationwide was 10.63%, and by April of 2014, the delinquency rate had risen to 11.89%, almost double the percentage of a stable market. Imagine the inventory of non-performing notes that creates. FHA by itself has a delinquency rate of more than 25% and has announced they are getting out of the foreclosure business and will sell non-performing loans instead. In July of 2014, the FHA sold 25,000 non-performing notes. 25,000. But wait, there's more, at least from Freddie Mac. In March of 2015, Freddie Mac sold the largest pool of non-performing loans so far, $1 billion. This article goes on to say that Freddie Mac has been accelerating auctions of soured mortgages after the housing crash. And this is something we're going to see on an ongoing basis for a period of time. So you can see that market conditions are very advantageous for note investors today. It's estimated right now that there are 350,000 REO properties available to buyers. That's nationwide. But there's 9 million delinquent notes. Now, I bet you might know somebody who invests in short sales or foreclosures or bank-owned properties. Maybe you have invested in property that way yourself. Imagine if you had over 20 times the inventory to choose from. This chart shows the number of sales of the 3 main types of distressed real estate assets in the past few years. You can see that the amount of non-performing notes that sold 5 of the last 7 years drastically outnumbered the amount of REO and short sales that sold in those same years. And by 2014, you can barely even see the short sales. It's just a little blue shadow under those 2 big pink boxes. Now I want to go back to short sales and foreclosures, or REOs, for a moment, just to illustrate a point about buying at a discount. Not only is inventory going down for short sales and REO property, but investors are paying more. According to the National Association of Realtors, in 2012, short sales sold for an average discount of 13%. So investors on average are paying 13% below the value of the property. That's not much of a margin. In that same year, foreclosures, or REOs, sold at an average discount of 21%. In 2014, short sales sold at even less of a discount. And for foreclosures, the margins tightened up to just 15%. So let's take your average $200,000 house and look at a hypothetical example. The short sale investor gets the house at an average discount of 12%, which means he buys it for $176,000. That leaves him a margin of $24,000 to squeeze his profits out of after his expenses, repairs, real estate commissions, and so forth. The REO investor gets the house at an average discount of 15%, which means he buys it for $170,000. That leaves a margin of $30,000 for him to squeeze his profits out of after his expenses. Now, the note investor is paying anywhere from 35% to 65% of the value of the house for the note. Now, let's be clear, the note investor isn't buying the house, he's buying the note. But the house is the asset that secures the note, and we'll talk about this more later on in this presentation. So let's say the note investor pays on the high side of the range and purchases the note backed by this $200,000 house for $115,000. That leaves an $85,000 margin for the note investor to work with. So you can see that one of the biggest advantages to investing in non-performing notes is being able to buy them at a significant discount. Now let's talk a little bit about the strategies after we acquire a non-performing note. We can modify the loan, and that's where the borrower wants to stay in the house. We purchased the note at a discount, so we can truly modify the loan for him. The borrower is going to pay us a lump sum. We're going to offer that borrower a lower monthly payment, which again we can do because we purchased the note at a discount. Then we have a reperforming note, which we can either sell to another investor or keep in our portfolio for the monthly cash flow. Everybody wins. If the borrower doesn't want to stay in the home or can't afford to pay a modified loan and wants to avoid a foreclosure on his record, we're going to get a deed in lieu from him. If the borrower can't be contacted or won't sign a deed in lieu, we're going to get a foreclosure. Either way, we end up with a deed to the property. Let's take a sample loan modification case study and take a look at it. Now, this was an actual note, an actual mortgage note on a delinquent mortgage note on a property in Homestead, Florida that came up a few months ago. The estimated as-is value was $84,000. The estimated after repair value was $92,000. It was a 3-bedroom, 1-bath home. The estimated market rent was $1,300. The amount owed on the note at that time was $148,000. And the payment, even though they were delinquent on it, the principal and interest payment was $1,024. The asking price on this note was $43,000. So, if we were to modify this note for that borrower, this was their current terms. They owed $148,000 on their mortgage. The interest rate was 7.39%. It was amortized over 30 years, and the principal and interest payment was $1,024. If we were to offer them a new loan amount of $96,000 and take a down payment of $8,000, leaving them a new loan balance of $88,000, offered an interest rate of 8.5% over 20 years, their principal and interest payment would be $764. So we could take their payment from $1,024 down to $764. So we saved the borrower around $250 every month, not to mention taking their unpaid balance down from $148,000 to $88,000. Let's say further that we collected a year's worth of those mortgage payments at $764, putting $9,168 back in our pocket. Then let's say we took the remaining 228 payments and sold them to an investor for $60,000. That investor we sold them to would make a yield of 14.25% on his $60,000. So what was our return? Well, we had expenses involved. We purchased the note at $43,000. The expenses of modifying the loan were around $2,000. This particular property had back taxes of $8,163 for a total cost of $53,163. We received the down payment from the borrower for the new loan of $8,000. We received 12 months of mortgage payments at $9,168, and then we sold the remaining 228 payments to an investor for $60,000 for a total of $77,168. A total profit of $24,005, a cash-on-cash return of 45%. Let's look at a deed in lieu case study. This was a note on an actual property in Oklahoma City, Oklahoma. The estimated value of this property was $36,000. The estimated after repair value was $44,000. This one was occupied. They owed $28,363 on it. The principal and interest payment was $226, and the average rent in the area was $680. And that's important because if we take the property back, we might want to rent it out. Asking price on this note was $14,181. Now this note wasn't a very good candidate for a modification. And if you think about it, look at that P&I payment of $226. We can't really modify that any better. If they can't pay $226, we can't really lower that and make it worth our while. So modifying this loan was kind of off the table. Let's consider what would happen if we did a deed in lieu of foreclosure. And that's again where the borrower agrees to deed over the property to us in lieu of a foreclosure on their record. We sell the property to a rehabber or end buyer, or we keep the property for the rental income. So, if we were to sell the property as is, what would our return be? Our expenses were, the note cost us $14,181. Expenses were $2,000. Taxes were $1,381 for a total cost of $17,562. We received the sale price of $36,000 for the home. Again, that was the as-is sales price. Figuring a conservative 10% selling costs for real estate commissions and such, we take in a total of $32,400 for a net profit of $14,838, a cash-on-cash return of 84%. What about if we did a deed in lieu but kept the property as a rental? Our expenses in that case stay the same, only this time we receive a monthly rent of $680, subtracting out $200 in expenses for things like taxes, insurance, and property management. We net about $480 a month for a cash-on-cash return of 32%. Let's look at a foreclosure case study, and this was an actual deal that an associate of ours did. This is a note backed by a property in Newport News, Virginia. The estimated as-is value was $55,000. The estimated after repair value was $86,000. The reason those numbers are so far apart is this one did need a rehab, did need about $20,000 worth of work. This is a 3-bedroom, 2-bath home. Estimated market rent was $860 in that area for a 3-2. Asking price on this note was $13,000. Now, in this case, they couldn't modify the loan, and they couldn't do a deed in lieu. The borrower wasn't available for either one of those. So they did a foreclosure, which again is when we foreclose on the property, obtain the deed, either sell the property to a rehabber or end buyer, or keep the property for rental income. So what's our return if we rented out the property after rehab? Our expenses were $13,000 for the cost of the note, $8,000 in foreclosure and other costs. The rehab cost $20,000 for a total cost of $41,000. We received monthly rent of $860 a month, less approximately $250 for expenses, again such as taxes, insurance, property management, for a net income of $610 a month, a cash-on-cash return of 18%. If we sell the property after the rehab, our expenses stay the same. We receive a sales price of $86,000, less a 10% selling cost, for a total of $77,400. Profit of $36,400, a cash-on-cash return of 89%. So this just shows you some of the possibilities that you can do with non-performing notes. Now I want to talk a little bit about investing with your retirement account. Obviously a Roth IRA or other Roth vehicle is great for note investing because you're going to be able to grow your money tax deferred. Also, you're going to have to consider that you can have certain scenarios where you might get a large lump of cash deposited back into your IRA that you weren't expecting, such as if you're holding a reperforming note and the borrower sells the house or refinances. In this case, it's going to be much better if you used your Roth vehicle so the taxes on that chunk of money will be deferred. Now, because notes don't have a lengthy closing time that most real estate purchases do, it's a good idea to park your self-directed IRA money with a fairly nimble company that can transfer your money quickly so you can make that note purchase. Some companies that are nimble enough to get your funds there on time are New Direction IRA and Quest IRA, to name just a couple. I'm sure there are more. Again, if you're considering notes as an investment, consider using a self-directed IRA. It can grow wealth for you quicker than you may think. Anybody who is interested in growing their self-directed IRA or other retirement vehicle through investing in non-performing notes, or performing notes for that matter, we're happy to work with you on an individual level. We'll be putting up our contact information at the end of this presentation for you. So to finish up our video today, let's just review some of the advantages of investing in real estate notes. As we've shown, today market conditions are extremely favorable to note investing. Notes offer options with a multitude of exit strategies, some of which we covered here today. They are an excellent tool to build wealth, especially within your self-directed IRA. You can diversify your investments both over assets, asset types, and geographically. We buy notes all over the country. Non-performing notes offer a higher yield potential with lower risk. You get to be the bank and grow your wealth efficiently with passive income and cash flow. They provide the security of being backed by real estate, and reperforming notes provide passive income without tenants and toilets. So again, if you have any questions and want to know more about this, please don't hesitate to contact me directly at beth@unitedcapital-llc.com or give us a call at that phone number listed below. Thank you very much for watching this video.